Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. Have you ever noticed that sometimes the Federal Reserve doesn't actually have to change interest rates to move the entire market? Well, that's exactly what happened last week. The Fed officially decided to hold interest rates steady, keeping the Fed funds rate between 3.5% and 3.7%. But investors weren't just watching the decision itself. They were watching every word in the statement and every signal about what would happen next. In today's video, we're going to break down why the Federal Reserve decided to keep interest rates unchanged. We're going to talk about what surprised investors the most after the announcement and what all of this means for the Federal Reserve, financial markets, and your wallet moving forward. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy easy to understand economics, finance, and market updates, please hit the like button, subscribe, and turn on your notifications so you never miss a breakdown in the future. Now, let's go ahead and get into the video. So the first thing, let's answer the obvious question. Why didn't the Fed raise or lower interest rates? The Federal Reserve has one primary mission. Well, it's a dual mandate. They actually have two, but we're going to focus on just one of them right now. And that's to keep inflation under control while maintaining a healthy job market. Raise rates too aggressively and the economy could slow too much. Cut rates too early and inflation could come roaring back. So this past meeting was about balance for the most part. The Fed decided to leave the benchmark federal funds rate between that range of 3.5 to 3.7%, marking another meeting without a rate change. So in other words, they're not really convinced inflation has been defeated, but they also don't believe conditions are strong enough to justify another or any immediate increase. It's a classic kind of wait and see approach, and that's exactly why this meeting matters so much. It's because sometimes the most important decision isn't changing the policy, it's deciding not to change the policy or leaving things the same. But that leads us to an even bigger question. If rate didn't move at all, what did markets pay so much attention? Why did the market pay so much attention? So here's where things get a little interesting, possibly get a little confusing. I'm going to try to simplify as much as I can. So the headline said that the Fed holds rates steady. But beneath that headline was something far more important. 3 voting members of the Federal Open Market Committee decided and wanted to raise rate by 25 basis points instead of holding the rate steady. That tells investors something really important. Even though rates didn't increase, another hike hasn't been taken off the table. So markets spend just as much time trying to predict the Fed's next move as they do reacting to the current one. So investors immediately started asking, is this simply a pause or is another increase coming possibly later this year? That's why Treasury yields, the stocks, and the US dollar all remained highly sensitive after the announcement. And if you're wondering why inflation isn't driving this debate, let's talk about that in a second. So inflation has cooled from its peak, but cooling isn't the same as reaching the finish line. The Fed's long-term inflation goal remains at 2%. Recent inflation readings have improved compared with the worst of the inflation surge, but policymakers continue to worry that higher energy costs and other price pressures could keep inflation elevated longer than expected. Now that explains why some officials argued that one more rate cut would provide additional insurance against inflation becoming out of control. Think about it this way. The Fed would rather keep inflation from flaring up again than have to slam on the brakes later with a much bigger rate increase. That's why even a meeting where nothing changes can send a powerful signal, because every meeting helps shape expectations about the next one. Quick pause, guys. If you want more breakdowns like this that explains the economy without all of the confusing jargon, please make sure to subscribe, like the channel, and share this with somebody who's into this kind of content. Now let's look at what this means for investors. So Wall Street wasn't just listening for the decision. It was trying to figure out tomorrow's decision. So higher interest rates generally make borrowing more expensive. That can slow consumer spending, reduce business investment, and often put some pressure on stock valuations. But if investors believe rates are close to their peak, markets may respond more positively because businesses and consumers have greater certainty. Bond markets were especially focused on the future policy guidance, with Treasury yields reacting as investors the likelihood of additional tightening later on this year. In other words, the Fed didn't just influence the market, it influenced expectations for the months ahead of it. So what does all of this actually mean if we're not professional investors? Okay? It means a whole lot. If you're shopping for a home, for instance, here's an example. Mortgage rates could remain relatively elevated as markets continue pricing in possibility of a higher for longer interest rates. If you carry credit card debt, borrowing costs are still going to be expensive. If you're saving money, higher interest rates generally continue to support stronger yields on many savings accounts and certificates of deposit. And if you're investing for retirement, expect continued volatility whenever new inflation reports or Fed committee reports are released. The bottom line, the Fed didn't dramatically change policy, but it reminded everyone that the fight against inflation isn't over with yet. And until inflation consistently returns to target, interest rate discussions will continue driving financial markets. So here's the big takeaway. Yes, the Federal Reserve did hold interest rates steady, but the bigger story isn't that policymakers remain divided. Inflation is still above target, and future rate discussions are far from settled. That means every major inflation report a major role in shaping what the Fed's next move is going to be. Now I want to hear from you. Do you think the Fed made the right decision by holding rates steady, or should they have raised rates? Leave your thoughts in the comments. If you found this video helpful, please like, share, and subscribe. And remember, this is Evanomics 101, your #1 source for everything econ.